normalization of the global oil market. And combined with growing AI adoption, which could improve corporate productivity and margins, but also combined with ongoing investment in technology, those factors could drive a healthier, probably a broader equity market upside participation.
Welcome to this month's Market Outlook podcast, where we will continue to offer our guide to the financial markets. My name is Lorna Denny, and I'm joined by our investment strategist, Aymeric Forrest. Good to see you back on the podcast, Aymeric.
Hi, Lorna. Hi, everyone. Always a pleasure.
It's good. Now, it appears a settlement to the Middle East conflict could now be in sight, and at least that is what the markets appear to be discounting. Could you perhaps give us a few highlights of the strong markets we've seen in the past month?
Yes. So April very much marked a sharp reversal from what we saw in March, at least for equity markets. Stocks were up between 5% in Europe and 14% in emerging markets. The S&P 500 was up 10% roughly. What is also worth noticing was that growth outperformed value stocks by 5%. Same on the fixed income side, credit outperformed government bonds. Government bonds were pretty flat for the month, and oil continued to rally on the months, although we've seen some headwind flow from the Middle East. So year to date, oil actually has doubled in price. Equities are up, probably back towards the level we last saw at the end of February, and actually for some markets, new highs, like in the US. Bonds are roughly flat to down, and credit is slightly up. Ultimately, the devil is in the details. The strong equity performance was mainly due to semiconductor stocks. So if we look at the Philadelphia Semiconductor Index, the index was up 39%, and actually it rallied further in May. So today, 12th of May, so as of the 11th, let's say, it's an index that is up 70% year to date. So it's been the main driver of equity markets this year.
These are strong markets indeed, but if we think then the impact of these months of conflict, including the effective closure of the Strait of Hormuz, it's likely to stretch far beyond the geopolitical sphere.
Yes, indeed. We've seen it before. Most economists and central bankers have reviewed their growth forecast lower and their inflation forecast higher for 2026 over the last month or so. Our own economists expect Europe to grow less than 1% this year, and inflation to reach on average 2.7%. The US seems a little bit more resilient on growth. So growth is expected to be around 2.2% this year, but inflation could remain above 3%. As a result, we also have central bankers that are cautious. They are in pause. They're observing the impact of the event on the data, and they may start acting as soon as June eventually, especially in Europe, if the geopolitical situation keeps pushing consumer prices upwards. On our side, we expect 2 hikes still in Europe and no change in the US in the second part of the year.
You seem to have outlined a largely cautious backdrop there, and yet corporate earnings have come in strongly for Q1, and they're being revised upwards for the full year.
Yeah, it sounds like a paradox. It looks like a paradox, but there are explanations behind. So indeed, equity markets were very resilient. It was mainly supported by a robust first quarter earnings season in the US, in some emerging markets as well. Earnings growth there is at probably its best pace, best level of momentum is since probably in 5 years. So you have to go back to the fourth quarter of 2021 to see such impressive quarter, impressive results. But that has been driven by massive AI-related spending that favored essentially the semiconductor sector. So hence the strong performance, we talked about it earlier on the semiconductor side, but also strong earnings. And earnings revision have been very positive, again, particularly in the US, in some emerging markets, because of those semiconductor stocks. The first quarter earnings was revised up 11% for the S&P 500 between the end of March and mid-May, so the 11th of May. And the earnings per share are expected to grow 22% this year. So just to give you an idea, a month ago, we were expecting only 13% of growth, yeah, so 9% more over this short period of time to achieve 22% of growth expected this year. However, the earnings momentum remains very concentrated, as I said. It's around for semiconductor, around AI. Semiconductor stocks represent now 17% of the S&P 500. They are expected to grow earnings by 90% this year. 5 stocks contributed to 32% of the earnings growth of the S&P 500 this year. And if you take Micron alone, it contributed for 12% of the growth of the index. So we're talking about extremely concentrated, but also incredibly strong numbers for those sectors and those stocks. Encouragingly, the equally weighted S&P 500, so you take the S&P, all the stocks, same weight, is still expected to grow its earnings by 9% this year. So it's not as great as 22%, but it shows that there is some life in some other sectors as well.
Yes, as you suggest, that beyond the AI boom, we could see some broadening of earnings. Will all this be enough to continue to fuel the risk-on rally in markets?
So a geopolitical normalization could allow for a gradual broadening of the recovery to other sectors, thanks to, for example, improved consumer confidence and global activity. For now, it's not the case. Okay, so in the short term, growth and inflation data are likely to continue to be affected by energy tensions, and consumer confidence is not at its best, I would say. For example, if we look at the first quarter real GDP data in the US, they were released recently. So the real GDP in the US was up 2% year on year. 1.8% of those 2%, so 90% of contribution, came only from intellectual property, software basically, and technology equipment. So if you exclude those two components, if you exclude also the contribution of government, the economy was actually contracting minus 0.3% in the first quarter. So economy, earnings, obviously returns, they're all linked, and a broadening need a more stable environment for the economy, for then after the earnings and translate into better returns. Our core central scenario is for a de-escalation of the conflict to be followed by normalization of the global oil market. And combined with growing AI adoption, which could improve corporate productivity and margins, but also combined with ongoing investment in technology, those factors could drive a healthier, probably a broader equity market upside participation. But it has to happen. Yeah, of course.
Yes, it's a lot to be proven there. So what adjustments have we made then to our asset allocation?
Yeah, so of course, we cannot ignore the geopolitical situation, but we cannot ignore the current technology trend either. So we remain constructive on risky assets with a preference for US equities. But we have added also preference for global technology, for emerging markets. We maintain our exposure to high yield credit. However, the geopolitical backdrop remains highly volatile and could continue to generate episodes of volatility, particularly in energy markets and sovereign rates. We have increased our exposure with a moderate positive view over the next 12 months for equity, mainly because of the earnings momentum. As I mentioned, we retain a preference for the US, for emerging markets over Europe, because again of those earnings, because of the corporate margin. But also Europe remains more exposed to the consequences of the energy shock and potentially to more persistent inflation. And for that reason, we are underweight on government bonds. They could continue to suffer from this inflation, and we prefer credit and high yield. The corporate fundamentals remain relatively resilient, with limited refinancing needs at the moment, and the default rates still are contained. However, on the default rates, we will have to monitor over the next 6 months, especially with regard to the geopolitical situation and the potential impact on the economy.
Thank you, Aymeric, very much indeed.
Thank you, Lorna. Thank you very much, everyone.
And if you found this episode interesting, do visit our website for more of our team's insights, including previous podcasts and our series of investment basics articles. You can find us on Apple, Spotify, YouTube, and all leading podcast apps. Search for BNP Paribas Asset Management, updates for AXA, and subscribe to our channel. And if you like what you hear, then please do rate our podcast on your chosen platform. Thank you.